Well, howdy there, folks. James, Political Friar, coming to you again. I got the Seattle Mariners hat on, which means we're going to be debuting a new category of videos, and that is to do with the markets. Not most, some of you who read the original Political Friar blog back in 2008 and 9 know that a big part of what I did was explain what was happening during the housing meltdown in 2008 and 9 and trying to make sense of the market news. And so we haven't had much call for that during this most recent run of this show because there hasn't been much market news. Mostly the markets have been consistent. They've been sort of good, for lack of a better word. Good. Well, on Monday, we had a really weird occurrence, an occurrence that if everybody realized their losses, would have resulted in the multi-trillion-dollar loss in value. Now, most people didn't realize their losses, so stop freaking out. But everybody did freak out a little bit. Like, what happened to the stock market? Last Monday, 6 days ago, the stock market plunged more than 10%. It's sort of levels that you were like, oh no, this is some kind of stock market crash. 1929 was flashing up and down, or maybe 1987, but it wasn't. It wasn't. It wasn't. The stock market crash was driven by three things, none of which are long term, all of which mattered, but none of which were long term. The first thing that drove the stock market crash was a uh, less than perfect jobs report. That is to say, that the jobs report came in a little less than ideal, maybe 1% less than ideal. And they had priced in what they expected, which is jobs reports exceeding expectations. That's what has happened in the last five or six jobs reports, which is all of those have exceeded expectations. So everybody was betting on this one, not being accurate either. Well, yeah, it's more accurate, and so that means that investors were a bit over their skis on their equity evaluation, and so that should trigger a sell off. And that's not a sell off based on any kind of fundamentals or long term things. It's just a sell off based on oh, well, hey, we thought this was bigger than it was. Not to say it won't get to be that big eventually, just to say it's not as big as it is now. So there's no reason for panic on that account. Now, the second reason that there was a big market sell off was the profit numbers that were reported by a number of impactful stocks. And things like NVIDIA and supermicrocomputers and others, those profit numbers came in at expected, not above. The thing is, the market has gotten used to these technology companies exceeding their expectations, simply meeting their expectations, which is to say that they are justifying their stock price, wasn't sufficient to actually keep their stock price up because everybody's looking for the easiest launch. They're all looking for the biggest differential, the one where somebody's going to outperform, somebody's going to surprise up, and in that these tech stocks who reported their earnings this week, they merely met expectations wasn't enough. And that led to a gigantic sell off, which led to a gigantic sell, which led to retail and other investors saying, we're going to get out because we're afraid. And it was a vicious cycle. So everything that was in the tech area got sold mostly because of fear, not because of fundamentals, but because they thought that this was a golden goose that would never stop laying eggs. Where the goose just hiccuped, they crapped out. Probably not justified by the fundamentals, but it's understandable that if you've got all your money in one thing, you shouldn't ever take bad news or even neutral news calmly. But the big thing that caused the stock market to go all wacky was the yen dollar trade. Y'all don't know about this, but it's really simple to understand. So understand, the yen will buy you X pounds of wheat or coal in Japan, and the dollar will buy you similar X number of wheat or coal in the United States. And the yen, compared to the dollar, was tremendously undervalued. You could borrow in yen at like 0.5% interest rate. And that means that you could borrow in yen, buy anything you want, maybe a stock, and then sell it in dollars with a much higher discount rate because the dollars were trading at like 5.5%. And so all you had to do to make free damn money was borrow in yen and sell in dollars. It was super duper easy. You were making 4%, which is great. There are a lot of stocks that do better than that, but if you can do 4% for sure with zero risk, yeah, absolutely do that, which was the yen dollar trade until folks started getting anxious about the value of the yen. See, the yen has been appreciating. That's weird. The yen for the last 20 years is depreciating. The yen has been stable or actually depreciating for a long, long, long time, mostly because the Japanese economy hasn't been expanding for lots of reasons. The problem here came that the Japanese economy looked like it was doing better and better, and not better than the US economy in real terms, just in comparative terms. That is to say that the Japanese economy might be growing faster than the US economy, which means that the yen's value is going up faster than the dollar's value, which means that your margin for your yen dollar trade has decreased, which means that maybe you want to invest that money in something else, which means that you need to liquidate those yen dollar positions. And when you liquidate them, you need to take the price that is given, and those folks who are in a position to sell in the yen dollar trade, the folks who have dollars who are willing to take yens, they're going to take a premium. And that caused a massive meltdown. The value of the yen oddly going up meant that selling contracts evaluated in yen in dollars massively went down. Okay, if you followed all that, I'm impressed. It's not a simple concept. Here's the takeaway. The takeaway is it's all very, very temporary. The yen and the dollar will find an equilibrium. This rather extreme divergence in their price has caused a real disruption, but that translates into equities going nuts. Not because they aren't exactly as valuable in real terms as they were before, but they aren't as valuable in yen terms as they were before. So everybody needs to go ahead and just chill out. And you saw this in the stock market. This was something that was digested over the course of the last 4 days. There was an exhaustion point that got reached on Friday where everybody was like, oh, we're good. And next week is a new week. This was not more than a super duper fascinating case study for some MBA in the next 5 years to say this is how markets work. This was, to borrow a phrase, a nothing burger. Now, there are going to be folks who invested on exactly the right or exactly the wrong security who will find this super duper important. But for the vast majority of us, if you didn't pay attention to the news last week, you didn't lose anything, at least not as far as the market goes. And that is usually the right answer. Listen, usually, if you make a solid choice and don't pay attention to it, you've made a good investment. That's usually what happens, and that's what happened this week. The folks who sold all their equities, they'll regret it because in the end, nothing happened, and that's good. All right. Anyway, I got a new hat on, so if you want to hear more market news, that'd be cool. Hit that like button, subscribe if you will, or leave me a comment. Anything you do that interacts with this video means that more people see this video, and I'd really appreciate that. All right, I'll talk to you soon.